Our market master of the day is Venugopal Garre, is Managing Director at Bernstein. Venu, good morning. Thanks for coming back on. Appreciate your time. The guest earlier on in the morning was saying it's a die-hard market. Actually, he was not referring to India, but he was referring to the global equity space. And he was saying, well, he used that phrase die-hard a few times. But I think it applies to the market here more than anything else. The strength has been unbelievable, isn't it? In the face of all of that, what is happening? Your thoughts?
Thanks, Prashant. In the way we've been sort of arguing on the market is, look, my Nifty target is around 19,000. Really doesn't matter, because while the target might look lower than where the market is, I've generally been arguing for the fact that I'm still positive on the equity markets, because I'm looking at things from a 2 to 3 year perspective, where I'm looking at a cycle view. And that's why I don't want to be seen at this point of time, highlighting that I'm worried on the market. See, my contention is there might be drivers for sort of short-term corrections in the market, but then I do see and believe that this is a market where you buy those corrections. Now, a deep correction, of course, is not something that I anticipate. When I say deep is you see a 15% cut in the market sustaining it there. There could be 3%, 5% corrections, which could be episodic, driven by sometimes commodity prices moving up or some local factors driving that, right? So that's like the broad view that I have held. The second aspect to it is, if you were to just generally think through, I wrote that in my portfolio report as well. Has the market really done well over the last 2 years? Because see, this is not about 1 month, 2 month trading. Think of a 2-year bucket. Nifty 50 has given you a 2.5% CAGR. Next 50 has been flat over 2 years. What you basically see as returns is, the so-called SMIT, which is 8 to 9% up on a CAGR basis from its peak in 2021 end, right? So that's basically what has delivered you some returns. But then FD returns are 7.5%. This low risk returns are still generating you that much. So top 100 stocks in an average have generated you lower than FD returns. So does it really mean that we are sitting on the top of a very heavy return cycle for India? I don't think so, which also gives me that view that if your earnings are going to be somewhere down the line in the mid to low teens for a couple of years, there are still anchors to protect material downside for India. So that's the approach I'm using right now. Yes, I haven't really changed my Nifty target yet.
Okay, got it. Venugopal, hi, good morning, and thanks for joining in. There is, of course, this huge humanitarian crisis that's currently underway, something that perhaps we as millennials or people of our generation have not seen, right, for a very, very long time. Just the scale of it, the escalation of the crisis over the last 10 days, and we don't understand what the financial ramifications, economic ramifications of this could be. Would that be a large concern for you? Because already we're seeing a lot of risk aversion, whether it's gold prices moving higher, whether it's Brent crude surging. Now, the Fed chair talking about inflation being too high, etc. How would you sort of read into all of this?
Yeah, so my read is that you're right. I mean, I know what you're referring to, especially the sort of mini wars happening in 2 different parts of the world, the second one being more recent. Now, the fundamental reality is that, I think the world construct is very different. The nature of wars are very different. They tend to get isolated in specific geographies without much of a global ramification, right? It's very clear that a lot of the developed world is willing to sort of help, at the background rather than directly willing to participate. So what it means is that the usual risk in such episodes is, does it really percolate and become much larger into, let's say, a global war, right? When I don't want to use a word world war in that sense, but the reality is that will be a big risk for the markets, right? But I don't really envisage that sort of a situation happening at this juncture. And in fact, honestly, even if it happens, you can't really predict it or really position yourself for that sort of a situation. Because think of it from a perspective of portfolio investors as well. A lot of my client base basically run funds. They can't be in more than 10% of their portfolio in cash. So you have to really take a proactive portfolio call in any sense. You can't go to a zero or put all your money in fixed deposits, right? So that's the unfortunate reality, and you can't plan for these things. So I'm not really taking this as a base case that things will sort of deteriorate to such an extent that we need to worry. The second, from a war perspective, now the second thing is, does it lead to a situation where commodity prices sort of start to spike, from a short-term perspective because of some supply constraints emerging because of how things shape up? Yes, that would be a material cause for concern, at least for a short-term point of view, and that's something which India can't digest, right? So that's like a worry. The third thing is on interest rates. I'm not really too bothered. My view, which I've held primarily to a large extent is that I don't think we have fully peaked on interest rates. The way things are shaping up in US, especially the way the economy is actually still very resilient. I spent almost 15 days in US just about the last 2 weeks. And to me, looking at how things are going on the ground, I could clearly feel that the economy is still buzzing. So the fundamental reality is that inflationary tendencies might still come through locally. Now, if that's the case, your interest rates haven't really, sort of peaked from a Fed sense as well. So what will India have to do? I think this time around, I think if rates go up globally, we have to follow maybe a 25 bips increase or a 50 bips increase over a 12-month view. That's what I have actually held through. But that's like incrementally, not so large a percentage change to honestly change the equations, from a point of view of how economic growth pans out. So I'm not too worried about the rate cycle. That's the way I would characterize it. Yes, there are risks to a large extent that you see in the part 1 and part 2, which is war and what happens to commodities, which we need to acknowledge, but you can't position for it.
Hi, Venu. Good morning. Venu, the Indian markets out here, the domestic flows have been splendid. So pat on our backs as well, because the SIP number is looking very, very good. The problem is the FI number, well, that's dwindling a little bit. And they sold in the past month as well. But there's plenty of money waiting on the sidelines. How are you viewing this, FI flow, the interest in the Indian markets? And also, more importantly, the mid and the small cap party is well and truly on. Are you seeing interest as well from foreign investors towards the broader markets here in India?
Yeah, so very valid questions and pertinent because I had my round of very good meetings globally. So, just to highlight, yes, the last 1.5, 2 months of small correction in terms of FI outflows that you've seen is more tactical. Honestly, the feedback globally is not about negative India. They're not really worried about India macro story, domestic cycle story, or the next 3 or 10-year story. It's more a period of consolidation, valuations having, sort of hit sort of a ceiling at this juncture. So there is some episodic correction sort of happening at this juncture from point of view of flows. But $3.5 billion is not like a big deal in terms of, how allocations are shaping up. But the fundamental reality is that I do see a lot of money sitting on the sidelines. Now, this money sitting in the sidelines is not about new money getting created out there or new fundraisings. It is basically about allocations that most of these global/emerging market funds are yet to do into India meaningfully. See, passive weights increase is a different thing, where your China portfolios didn't do well, so you automatically ended up having India having a higher weight. Because of that's a very different thing altogether. I haven't really seen at this juncture very major active shifts in terms of weights. Part of that, as I highlight, is more because of the fact that capability building is required. Quite a few of them, used to look at a few large caps, but they realize that's not the way to manage the market if you're going to be playing only ADRs and buy an Infosys and HDFC, right? That's not like the way to manage your portfolio. You have to basically be a bit more broad-based into India. This is where the conversations were. And I think that's what FII's next stint would be, thinking about how to broaden portfolio into the 150th stock, for example, in terms of market cap. Of course, 250 and beyond is still very tough for them in terms of liquidity. But that's like the next step. And we are actually having a lot of conversations around, on how they should sort of approach that sort of investing in India. Nothing is going to change in 3 to 6 months. These trends in terms of being ready to invest in India, building capabilities, having manpower who understands India is at least a 2-year process. So you're going to see, some money coming in as corrections happen. But then even at the current level, if you have to see a lot of money, you need to see this to happen. And I think this is happening from an Indian construct.
Hire more people to cover those 150 next stocks. Because build capability, right, is what you said. But that's going to be interesting to watch, right, as foreign brokers start to cover, because typically now you got to go to you got to look for coverage, etc., especially if you're on the buy side for smaller companies, which perhaps will change. But will it change because these smaller companies would have already become big, or will they go down when they're still small? I think the latter would be more preferable. Your top ideas, Venu, from here, in terms of incremental upside, absolute incremental upside, if you can share a few names with us.
Okay, so I actually, was trying to resist giving names, but since they're a part of India portfolio, I guess it's okay to mention names rather than digging into details on them. See, the way I look at it is that, look, honestly, as you rightly said, it is also about coverage of stocks. So we don't really have too much mid coverage. It's also, something we would be looking at. But the reality is, I've got a 20% allocation to SMID. I don't really differentiate between SMID and large cap. So there's no argument we're making that, hey, shift from SMID to large cap. I don't think it really matters. These are very difficult to execute trades. We're pretty agnostic to a SMID or large cap. It is just about which business model is correct, where you can generate returns is what our current strategy is. So we have maintained a 20% allocation to SMID. Outside of that, I would probably argue that stocks which we think are alpha generators at this juncture amongst industrials is something like L&T, which I think is a doubler over a couple of years in terms of a cycle view. So the story is not done yet. Outside of that, to play housing and building materials, I'm still pretty positive on building materials as a space. I have Ultratech as a portfolio stock at this juncture. We're neutral on that stock from a house perspective, but it's in the India portfolio, just largely to play the 3-year view, not really the near-term sort of issues around other aspects. Then consumer tech is a pretty heavy overweight for us. So we have stocks like Paytm Delivery, which is Paytm is recently added in the India portfolio, and Zomato. These three we're still willing to hold on for a while, but do acknowledge, I want to highlight that I'm not taking a 5-year view on these stocks. We typically take a year or a quarter's view and then see how things evolve in these business models. So these are 3 stocks that are there in the India portfolio. Financial sector, has been a bit tough for us in terms of how it's shaped up. But laggards like HDFC, we're not willing to let go of that. So it's been in the portfolio for a while. That's something which we still think that would play out well for us over a 3-year view. So that's CFC Bank basically, and then Axis. So there are 2 stocks in the very narrow, smaller portfolio in the financial sector at this juncture that we are holding. So these are a couple of names basically which are top of the mind for us in terms of how we are building the portfolio.
Okay, all right. Thanks a lot, Venu, for stopping by and filling us in with those details and sharing some names as well that are part of your India portfolio. Look forward to having a chat with you rather soon.